Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 22nd of September 2019 and we are digesting a report published by Reuters on Friday entitled Asia Gold Demand Tepid in Top Markets. India Muted Ahead of Festivals. We highlight what this report states and express our view as to whether we should be concerned or not. We make no apology for today's short video, as we're currently working on a number of comprehensive ones which will be published this coming week for both free and in the Sanctum members. However, during our research we came across a Reuters article on Friday which suggests that physical gold buying is rather tepid in some of the top gold buying markets. Now this report highlights three key factors to take note of. 1. Indian dealers offer steep discounts of around $47 an ounce. 2. Singapore premiums narrow to 55 cents to 75 cents an ounce. And 3. Chinese premiums are little changed at $10 an ounce. These are then supported by the following comments. Quote, physical gold demand was lackluster in most Asian hubs this week, as price dips were not enough to lure in buyers, and the Indian retail market saw little activity before a festival season. Unquote. Now, in addition, Ronald Loing, chief dealer at Lee Cheong Gold Dealers, is quoted as saying, quote, premiums in Hong Kong were unchanged at 50 cents to $1, as demand was weak and buying only came from the investment side. Unquote. In India, a Mumbai-based dealer at a private bullion importing bank is quoted as saying, quote, jewelers are still not making purchases for the next month's festivals, anticipating weak retail demand. Unquote. So the question is, should we be concerned that perhaps those countries, notorious for being the major acquirers of gold, have, at least for the moment, become apprehensive about acquiring much more at current prices? Well, the answer is really no. Traditionally, the last quarter of the year is when India normally makes the majority of its purchases, even though there have been extra taxes placed on them to do so this year. Thus, their recent move to much more considerable silver acquisition. However, we are still expecting a reasonable acquisition of gold. Also, central banks are still buying gold at record levels, and that there are sufficient geopolitical concerns to keep the gold market buoyant. Now, what is interesting is that when the gold price rises, we often see a slowdown in physical purchases, especially from China. But considering the quantity they tend to buy, this should not be surprising if they adopt the same practice as many of us, which is buying on dips, not necessarily at peaks. The greatest threat to gold acquisition is, of course, the availability of more lucrative alternatives, which up until now, to a large extent, have been equities, and to some extent, property, certainly in certain parts of the world. And the US dollar, let's not forget, which has gained in some strength when compared with other currencies. Now that said, in our view, whilst we are of the opinion that gold is overbought at this level, and therefore should go down in price by around $50 to $100 short term, To be frank, the prospect of lower interest rates ahead, the China-US trade conflict continuing, a slowing of the global economy, and increasing tensions between Iran and Saudi Arabia and the US are more than enough to keep prices reasonably buoyant and certainly preventing them from falling to the lows experienced in recent years. Now, that said, with more liquidity being placed into the system, and the prospect of even easier credit will also likely fuel other markets too, which to some extent then help prevent gold and silver from rising considerably higher than the current levels, at least for the time being. Now, of course, and as we have often stated, the Iranian conflict in particular could be the largest catalyst for increasing prices on our horizon today. Not totally discounting, of course, the China trade war, but this one in particular, especially bearing in mind the threats made from all sides of this developing conflict. What we do warn our subscribers of, though, is not to be taken in by those telling you there is a gold shortage out there. Perhaps certain coins may be in one or two areas, but we've contacted a number of dealers both in the UK and in Europe in recent days, and they assure us that they can certainly supply at competitive prices and in some cases reasonable discounts considerably more gold than we could ever afford to buy. So beware of the scare tactics, but also be aware that there is a slow but increasing case for buying gold, especially bearing in mind geopolitical concerns, lowering of interest rates, and a major slowing down of the global economy. Now we shall cover silver, because I'm sure most of you will be asking, what about silver? We shall cover this more comprehensively in another video. But in our view, the case for gold is still as strong as it has ever been. The question, as always, is at what price? Thank you for listening. If you like this video, please give it a thumbs up. And also, do subscribe so that you may be notified of future videos, and click the bell sign so that an automatic notification is sent to you. And also, if you haven't already done so, please head off to illuminatisilver.com and sign up as an Inner Sanctum member, either as a free member or a paying one. So until next time. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.